The following video is only the creator's own view and should not be considered as investment advice. Hey, welcome to Losing Money with Ken, where I try to get rich or die trying. Are you still waiting for the market to crash so you can purchase the index fund at a better value? Well, here is one indicator to check when is a good time to purchase the index fund. We can take a look at the PE ratio of the index fund. It's conveniently recorded by Bloomberg and also listed on the STI ETF prospectus fact sheet. So what is the PE ratio? P is the current price that the market is paying for a share, and E is the reported earning per share of the stock. The higher the ratio means that people are currently bullish and willing to pay a higher price for the share. A low ratio means that the market is bearish on the index and prices offered are lower. Why does this make sense? This is because the STI index has been a dividend play. The major constituents are blue chips that have been consistent in their dividends. If you are a holder for dividend investing rather than for growth, the cheaper that you can get them, the better it is. Let's take a look at the index at 4 significant periods from the last 3 years to locate the PE ratio where prices became discounted. First, we take a look at the ratio before COVID. 8 January 2020, the PE ratio is at 12.24. This was before the start of COVID-19 in Singapore. The market was already slow due to the ongoing trade bickering between USA and China. Trade slowdown will have a major impact on Singapore as it affects the manufacturing, electronics and logistics sectors heavily. 18 March 2020, the PE ratio was 9.5. This is the first sign of COVID getting out of control in Singapore, and 2 weeks before the circuit breaker announced. It took 7 months till October 2020 for signs of recovery. 6 April 2021, PE ratio at 49.17. As COVID cases dropped from its peak, share prices push up higher. 7 July 2021, PE ratio at 36. Market chasing and loading and unloading at a new baseline. 13 November 2021, now we see the PE ratio at 21.11. The market is no longer responding to the COVID situation, whether good or bad, as the STI constituents have largely priced in the continued impact of COVID in their future. 11 December 2021, the PE ratio at 19.95. Now we see that the price have stabilized along this range. From the readings, there isn't much euphoria from the announced calibrated opening as prices are not pushed up and not dipped significantly from the latest Omicron variant and QE tapering. So is it a good time to enter? The PE ratio is now about 20 and is still higher than the ratio at 9.1 recorded on March 2020 at the peak of COVID-19 fears. I feel that it's not a good time now as there are no discounts currently. The overarching story of QE tapering and US-China conflict will still have greater impact than COVID. Keep your eyes open for these two topics as their impact on the index will be much greater. That's all for today. Do post your questions and I will try my best to answer them. Please help me by clicking like for this video and subscribe to my channel Losing Money with Ken. That's all for today.